I'm joined by Virginie Maisonneuve. She's head of global equities at Schroders. Great to have you, Virginie. So,
thank you.
We were just talking in the break about how I was saying it's incredible that the MSCI Asia Pacific, the wider regional benchmark, has already erased the losses that came in the wake of the Japanese earthquake. Has that surprised you?
Well, I think that it is interesting to see. You're right, you could talk about a bit of complacency. That despite the Middle East, despite Japan, the markets have shrugged it off, and clearly there's a lot of liquidity around. Now, I think as we look into the second quarter of the year, the first quarter was really interesting. We started on a tone where people left emerging markets on the margin to buy deep value stocks in Europe. And actually, everything changed on March 11th, where the trend reversed and emerging market came back in favor as a safer haven. Looking into Q2, what do we have? I think we have much more volatility coming.
And the main reason for that is that we have the normalization of monetary policy. We have the end of QE2 coming in June, although there is uncertainty around that now.
Exactly.
As well.
I think if you look at QE2, clearly the government is going to look at several factors. Unemployment is one of them, and that's going in the right direction. Industrial production is going in the right direction. Loans, we see a slight pickup in loans and credit. That's going in the right direction, but property is not.
Right.
The latest numbers in February were quite weak. So I think we really need to see more data on that front.
So we're going to have to see more data before they make a decision about whether or not QE2 is going to be needed. But there's also been talk about a premature end to QE2.
And I think there, if you look at what happened with QE1 and how it was withdrawn and what the market did afterwards, that's a lesson that they're definitely looking at. So I think if the data is weak, could we have a sort of an extension of QE2 for a soft ending? That's possible. The data would have to be very weak for a QE3 to happen, but I think it's not all played out.
And that would be good for stocks. And some have even said that possibly the Japanese earthquake, the Libyan crisis, the unrest across the Middle East, that might just push the Fed to be a bit more cautious. But what about Asian central banks? Because they're sort of coming towards the end, some people are saying, of their tightening cycle. And I was talking to a guy from Credit Suisse the other day, and their house view is that inflation in Asia is going to be less of a concern in the second half of the year, not quite the second quarter, but the second half. Do you agree with that?
I think there's a very, very good point to that. There's several factors. One is the base effect. So remember, soft commodities inflation was very strong, and you have, because of the year-on-year effect, you have an improvement of that. Let's not forget that on a long-term basis, because of my three themes, demographic supercycle and climate change, soft commodities prices, I think, are going to continue to be strong. But starting in June, for some countries, particularly Asia, the base effect is actually going to be favorable. But let's not forget the oil price. And here, this is why, when I look at the rest of the year, normalization of monetary policies is very important. Is Europe going to make a mistake? But also what's happening in the Middle East. If you had a situation, and what I'm looking at is Bahrain, if you had a situation where somehow Saudi and Iran came into some kind of clash, and Saudi, as we know, is quite it's a stable and stable situation.
It's a game changer.
Exactly. I think, if you had a very strong oil price, the inflation story would come back. If that doesn't happen, I agree that a lot of tightening has happened. If you look at China, for example, that's the case.
But you're still looking at input costs and inflation as one of the main considerations when you look at investing in stocks. So what does your portfolio look like in the second quarter here?
So it's very much, we're positioned where we are, now it's very much a stock by stock basis. I have added back to the Chinese market. So for example, we had sold out the banks, and we've re-entered some of the banks. Added back to insurance as well recently. And I think in general, case by case, I'm still a little bit more cautious about Brazil in general, because there I think the government's intention to use other tools than interest rates to try to soften the impact of inflation may not be fully anticipated in the market. I still like industrials. Around the world. I like the US industrials. I think the US is gaining a lot of, the adjustment through the crisis has been very strong, and I think it's a way to play that recovery. But generally, I also like commodities and energy. right?
Commodities still set to rise, energy possibly rising as well.
Exactly, and particularly gas, because if you see what's happening in Japan,
with the nuclear situation.
That's right, you'll have a rebuild, I think, in gas utilities, and gas prices are still, the spread between gas and oil prices is still very large. So not only from a climate change standpoint, but also from an efficiency standpoint in that environment, until there's more clarity around nuclear in Japan, I think gas is going to benefit.
I just want to finish on Europe, because you say that it's going to be a policy mistake when they raise rates next month. But European stocks, Euro Stoxx 600, they're the cheapest, really. If you look around the world, they're valued at 11.1 times earnings. So would you be buying in Europe, or is the debt crisis putting you off?
I think it depends what you're looking at. I like companies like Schneider, for example, you know, productivity play, climate change related. But I think if you look at, you know, Europe overall as a bloc, and you think that peripheral Europe is still an issue in my view, and you know, we have Ireland, we have Portugal, we have Spain, I think you still have to be quite cautious.
We were talking about, first of all, Ireland, and of course we don't exactly know how much these banks are dependent on this ECB liquidity. They're still on life support, but so are many other European banks.
Yes, exactly. And I mean, we know that 35 billion has been earmarked for the Irish banks. If you go and talk to, you know, the market, we're expecting the need after this stress test to be between 17 and 25, so lower than the 35. To me, what's really important is, well, first, you know, what does that mean for a sovereign bondholder and senior bondholder? Because the more injection we have, the more likely we have to have a haircut. So here, two things. You have this sort of bargain between Ireland and the ECB. Ireland saying, well, we don't mind a haircut, and the ECB clearly not wanting a haircut because of the implication it might have for Portugal and other peripheral countries. So that's one thing.
And actually, Virginie, if we do have a haircut, the ECB is very prudent because we don't exactly know the ramifications of it. Will it push the banking system in Europe under so much pressure that we risk a collapse almost of it? If bondholders will take a haircut?
I don't know if it would be a collapse, but it would be a lot of pressure. And clearly at this time, because of Portugal, and you know, we have the 55 days because of the elections, etc., and then Spain, I think it would be very tricky. So what's really interesting is that the ECB has talked about setting up a new fund. That's not been confirmed. Apparently there's no full agreement within the ECB about that, because Ireland is running out of collateral, and we know they've borrowed about 190 billion already from the ECB. 117 came directly from the ECB lending facilities. If there is no more collateral to go through the normal or the standard facility, we're setting up a new fund on which, you know, we don't know what the standards are going to be to lend. It's not been confirmed, but I think that's quite interesting. And as we know, property prices are still going down in Ireland.
Yeah, so it does look like the resolution is nowhere near in sight, and you're right, we don't really have confirmation of what this new fund would look like. Now, the other thing we don't know, Virginie, there are more questions and answers really today, is the stress tests. We're going to get some results. We don't know what the criteria is.
No.
How concerning is that? Because last time they just weren't credible.
I know. We know that there are two criteria, liquidity and solvency. But actually, probably the reason why we don't know the exact detail leads me to believe that they'll probably come out a bit better than people expected. It gives some flexibility to the government. We know, however, that there will be some action. If you look at Irish Life, for example, they will need 2 to 3 billion. Euros, and they will probably be asked to sell some assets, as we know, pension areas, etc. So there will be some action. I think the idea right now is to take care of some of the 2008 loans, the bad loans, and trying to, again, kick the can down the road in order to buy time. It's going to be a painful adjustment, as we know.
Painful, and we'll have to see the results today. Virginie, thank you so much.
Thank you.
Virginie Maisonneuve there.